When most people think about McDonald's, they think about burgers, fries, and drive-thrus. They think about customers lining up at counters and cars circling the parking lot. From the outside, it looks like one of the largest restaurant companies in the world. Institutionally, that description is incomplete. McDonald's primary customer is not the person buying a meal, it is the person buying the right to operate under the brand. To understand McDonald's, you have to stop analyzing it as a food business and start analyzing it as a platform that sells operating rights, real estate access, and standardized demand. At the surface level, McDonald's sells food to consumers. That revenue matters. But structurally, the corporation's most stable and predictable cash flows come from franchisees. The franchisee is the long-term counterparty. The diner is a variable. This distinction explains how the company behaves. McDonald's does not primarily grow by opening company-owned restaurants. It grows by recruiting operators who invest their own capital to build and run locations under strict system rules. Those operators pay for the privilege. They pay an upfront franchise fee. They pay ongoing royalties tied to revenue, not profit. They pay rent, often to McDonald's itself, because the corporation frequently owns or controls the land and building. They pay into national advertising funds. They adopt mandated technology systems. They purchase from approved suppliers. From the corporation's perspective, this is elegant. The franchisee supplies the capital for build-out, the labor for daily operations, and the local management required to run the restaurant. The corporation supplies the brand, the operating system, the supply chain integration, and the real estate strategy. Risk and return are divided accordingly. If a location underperforms, the franchisee absorbs most of the pain. The corporation still collects royalties as long as revenue exists. Rent is often contractually fixed or structured to remain payable even during downturns. Advertising contributions continue. The corporate revenue stream is diversified across thousands of operators. This creates a financial profile that looks less like a restaurant chain and more like a business-to-business infrastructure platform. The key is real estate. McDonald's does not simply franchise a logo. It franchises access to prime locations. Over decades, the company developed an internal real estate engine that identifies, acquires, and controls valuable commercial sites. Franchisees are then placed into those locations under long-term agreements. The restaurant is the visible layer. The property control is the strategic layer. From this perspective, the burger is not the core product. The predictable stream of franchisee payments tied to real estate and brand usage is. This is why McDonald's can tolerate thinner restaurant-level margins than independent operators. Its economics do not depend solely on food markup. They depend on system-wide extraction of small percentages from very large volumes. The diner buying fries does not have a long-term contract with McDonald's. The franchisee does. This changes how the corporation optimizes decisions. Menu changes are not only about customer taste, they are about operational standardization across thousands of businesses. Technology upgrades are not only about convenience, they are about data integration and system control. Store remodels are not aesthetic exercises. They are capital expenditures imposed across the network to maintain brand positioning and asset value. The franchisee funds much of this evolution. This is the defining feature of a platform model. The corporation sets the rules, maintains the brand, and governs the ecosystem. The operators execute within those rules and pay for access. Seen this way, McDonald's resembles other platform businesses more than it resembles a standalone restaurant. The platform's goal is to make participation attractive enough that operators invest, but constrained enough that control remains centralized. Standards are strict, deviation is limited. Autonomy exists within a narrow band. The diner's experience matters because it sustains demand, but the corporation's contractual relationship is not with the diner. It is with the operator who is obligated to deliver that experience under defined conditions. This explains why McDonald's invests heavily in brand consistency. Brand is the glue that holds the system together. It reduces demand uncertainty for franchisees. It stabilizes cash flow for the corporation. It turns a physical location into a reliable revenue engine. Brand trust is not just marketing. It is risk reduction for the operator and asset protection for the corporation. Consider what happens when you walk into a McDonald's in a new city. You expect a predictable menu, price range, and service speed. That expectation is a form of economic infrastructure. It lowers the cognitive cost of choosing. It increases throughput. It supports the franchisee's revenue, which supports the corporation's royalties. Predictability is monetized upstream. The deeper institutional insight is that McDonald's sits in the middle of two markets. Downstream, it serves consumers. Upstream, it serves franchise operators. The upstream market is where long-term value is anchored. Franchise agreements last decades. Locations are difficult to relocate. Operators build their livelihoods inside the system. Exit options are limited and regulated. This creates a durable revenue base for the corporation. Consumers, by contrast, can switch brands at the next intersection. This is why the corporation focuses intensely on franchisee economics, training, and system compliance. A strong franchise network stabilizes corporate cash flows more than a single successful menu item. It also explains the company's resilience. When consumer tastes shift, menus adapt. When economic cycles fluctuate, franchisees bear local volatility, while the corporation's diversified fee stream continues. When new technologies emerge, upgrades are rolled out across the network with costs shared by operators. The platform absorbs shocks by distributing them. From a traditional perspective, this might sound exploitative. From an institutional perspective, it is a governance structure designed to scale a brand while minimizing corporate capital exposure. The franchisee is not merely a partner. They are a customer of the McDonald's system. They purchase a bundle, brand equity, site selection expertise, supply chain access, operating procedures, and national marketing. In return, they accept ongoing payment obligations and system control. The diner participates at the edge of this structure. The franchisee lives inside it. Understanding McDonald's means recognizing that its core competence is not cooking. It is orchestrating a network of semi-independent operators under centralized brand and real estate control. The burger is visible. The contract is decisive. When you buy a meal, you are touching the outer layer of a much larger economic machine. The real transaction that defines McDonald's business model happened when an operator signed a franchise agreement, committed capital to a location, and agreed to operate within the system for decades. That is where the predictable cash flow begins. McDonald's does not ignore customers. It depends on them. But institutionally, its primary customer relationship is upstream. It is a real estate and branding platform that monetizes a network of operators. The food is the interface. For continued institutional analysis of how companies actually make money, subscribe.